sometime in the first half of the year, gold gets to 2,300, just on that surge that I would expect. I just don't think there's any way that the gold-silver ratio at that point is going to be 100, right? So what would be a good number for that? 80? I mean, silver's going to come along, and then so it's going to do the same thing. It's going to break about 28 finally, 29, and all of a sudden it's going to have a 3 handle, and then it's going to jump too. Lots of profits that can be made trading, maybe the mining shares as well. And then we'll see, what happens once we get to 2,300 and, 33 or 4. Then we'll have to see where we go from there. But I feel pretty good that that's what's coming.
Both metals gained tremendous ground in terms of percentage gains. Market sentiment favored gold as a haven asset over silver. Gold pricing had a much more substantial gain than silver, while both precious metals had more respectable performances. CraigHemke, renowned for his insights into the financial markets, is the founder and editor of the TF Metals Report. In this video, CraigHemke focuses on precious metals, particularly gold, predicting a breakout from its multi-year trading range to surpass $2,300. Analysts are bullish on the bullion and anticipate the possibility of gold rates hitting $2,400 an ounce in 2024 on the back of a multifaceted interplay of economic, geopolitical, and market factors. Anticipating a rise in gold, Hemke foresees the gold-silver ratio shifting to around 80, predicting a substantial silver rally breaking through $33. The gold-silver ratio is dynamic, influenced by factors including the supply and demand for the two metals, the overall state of the economy, and the relative strength of different currencies. Silver tested new highs as the gold-silver ratio settled below 82. From a big-picture point of view, gold-silver ratio is moving towards the strong support level in the 78 to 79 range. Now we present the clips of CraigHemke's insights from his recent interview with Commodity Culture. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
What's curious about this year is I don't really know if I was, this sounds like standard gold bug, a kick the can kind of thing. There are a lot of people like me that are like, I don't know what I got wrong over the last 12 years. Well, it's not so much that you're wrong. It's just that this exponential growth of the debt, and the accelerating death of the system just takes a while. And kind of on a microcosm of that is my forecast this year. I didn't know that, after what happened in 2018, I didn't think the U.S. economy and the markets really could take interest rates much above 3%. So I figured we'd be there by spring and by the summertime, it'd be obvious impact of the economic slowdown and the Fed would pause and start talking about cutting. It's been delayed by about 6 months. Where we are now, late November, rolling into early December is about where I thought we'd be by like June into July. So I don't think I was necessarily wrong on the forecast for this year. I just think I was early. And so now I'm looking forward to next year to seeing gold move out above 2,100 and drag silver with it. Focused on, though, obviously, is the precious metals. And I still think, I expect, is going to play out. Gold has been in a trading range for the past 3+ years. Some people would try to say, oh, God, look, there's a triple top. Actually, it's like a septuple top. This is like 7 times. Gold's gone up to 2,000. Well, now that, as we're recording this, 8. It's in a range, okay? There are double tops and double bottoms. Anything beyond that is just hokey pokey. It's in a range. What typically happens, and I've seen this, Jesse, I became a stockbroker in 1990, okay? So I've seen this play out a few times in my life. Not even that. If it just moves forward and makes a new all-time high after a period of consolidation, that new all-time high generally creates some positive buzz. Right? And people are like, ooh, I'm missing out. They're seeing the headlines. Oh, look at the new all-time high. So think of that with gold. Gold finally breaks out of the range, comfortably north of 2,000, pushing 2,100. The headlines are going to be everywhere. Gold breaks out, new all-time highs, right? And people are going to start going, oh, maybe I should get some of that. And they don't want any of it at 1,800, right? Here in the West, maybe I should get some of that. Call their stockbroker. How do I get some gold? Well, we'll buy you some Newmont. This kind of thing starts to happen, and it creates its own buzz. Generally, when you make a new all-time high in anything, look at what happened what's been going on in orange juice. It creates its own momentum, and you get at least a 10% follow-on rally. just in the surge of momentum and optimism and all that, late people chasing it, that kind of thing. So let's say sometime in the first half of the year, gold gets to 2,300, just on that surge that I would expect. I just don't think there's any way that the gold silver ratio at that point is going to be 100. So what would be a good number for that? 80? I mean, silver's going to come along, and then so it's going to do the same thing. It's going to break about 28 finally, 29, and all of a sudden it's going to have a 3 handle, and then it's going to jump too. So to me, this is a pretty clear trade that's coming. Lots of profits that can be made trading, maybe the mining shares as well. And then we'll see, what happens once we get to 2,300 and, 33 or 4. Then we'll have to see where we go from there. But I feel pretty good that that's what's coming.
CraigHemke predicts a notable change in inflation and interest rate expectations, expecting institutional buying and a sustained surge in gold prices. When interest rates are low, the relative attractiveness of non-interest-bearing assets like gold increases as the opportunity cost of holding bullion decreases. According to Goldman Sachs strategists, the probability of a U.S. recession has fallen to 15%. In such a rosy scenario, falling rates should bode well for equities, diverting demand from gold. Despite the economic challenges, he predicts the Fed will intervene to maintain market stability during the election year, benefiting both the stock market and gold. Gold was moving closer to its all-time high as investors sped up bets the Federal Reserve will start cutting interest rates next year. Furthermore, Craig also stresses diversifying savings with gold due to fiat devaluation, as he foresees a continued rise in central bank gold purchases, anticipating sustained buying and market acceptance. Globally, central banks hold some 14% of their assets in gold. According to the IMF, U.S. dollars accounted for 58% at the end of 2022. Even a minor rebalancing could significantly affect the relatively tiny gold market. Let's get back to the interview.
The stock market, and it's people fear of missing out, right? Waiting for the Fed to cut, I don't want to sell because pretty soon the Fed's going to cut and then I'm going to be chasing and all that. Same thing as gold this year. I mean, it's not just the fear of missing out that's kept gold afloat. Okay. I mean, you've probably seen the charts, gold tracks real interest rates like this. And then all of a sudden there's this big gap, right? That at this level of real interest rates versus inflation expectations, gold should be $1,200. Why is it not $1,200? It's $2,000 instead. Well, there's a number of reasons for that, but one of them is fear of missing out. I mean, why would I sell my gold when I know that the Fed's going to be cutting next year and prices are just going to go higher? So yes, this change in inflation expectation, interest rate expectations, that buoys gold and eventually drives enough institutional buying of the futures contracts that it gets permanently above 2,000, which maybe begins in December, and then stays there. And then all of a sudden, you're closing the month above 2,000, you're wrapping up the quarter above 2,000, and people start going, and you get more and more people going, which is already, to double the amount of people that are excited about gold isn't very challenging because we're starting from a pretty small amount of people in the first place. And then it kind of feeds on itself. And then, like I said, you get $2,100 gold, new all-time highs, people talking about it. And you see 2,300, 2,400 pretty quick. In the matter of a couple of months. And I think that's what's coming. The markets will probably stay elevated, be bought on the dip like they have the last couple of times that we've had a 15, 20% correction the last 2 years. Turn around, right, go back up. So anyway, to answer your question, yes, there is a significant recession coming, and it's a stagflationary recession, and it's going to be brutal. Not for the people that actually own stocks, but for the 65% of Americans that don't even have $2,000 in savings that they can tap if all of a sudden they need a new set of tires on the Impala. Okay, this is a very mean time that's coming, and it's an election year too. The Fed will move to keep the markets afloat, and that will keep the stock market afloat too. Okay, and this can be very beneficial for gold too, because more and more people are like seeing the curtain pulled back and figuring out how this works. You and I on my site, whatever, there's countless other people you talk to. What do we tell people to do? Take some of your money. You don't put all your money in gold, right? You don't put all your money in anything. But take some of your savings that you're holding dollar-based, right? Whether it's in stock, fiat-based, I don't care where you're listening, euro-based, whatever, yen-based. You're holding yen, you're holding euros, you're holding dollars in the end. Take some of that and get out. Those things are being rapidly devalued, and it's only going to get worse. Take some of that and buy some gold. It's exactly what the central banks are doing. They accumulate dollars in their foreign currency reserves from international trade, and they're like, well, we don't really want to keep holding these, and we sure don't want to put them in treasuries. Let's buy some gold. So I don't see why that trend changes. And we already had the biggest year since 1968 last year in terms of central bank gold buying. It's going to be beaten this year by the time it's all said and done. We'll probably beaten next year too. And that's all part of the reason why you haven't seen gold go to 1,200 this year. Because there's just not that much physical metal laying around that these central banks, they want the real thing. Now, whether that then leads to hedge fund, and greater acceptance and buying gold and getting excited about it, well, there's lots of room for them to come in. Current open interest in COMEX gold is about 480,000 contracts. I've seen that over the time I've been doing this as high as 800,000 contracts. Okay? The net long position of the hedge funds and the large speculators in gold is not even half of what I've seen it reach. So there's all kinds of room for, buyers to come in and drive the futures price higher.
Peaking interest rates and growing geopolitical unrest have put a spring in the step of gold bugs worldwide. In an ever riskier world, even the prospect of a soft landing for the U.S. economy has not significantly dented the metal's appeal. Central banks have been upping their holdings. Over the first 9 months of 2023, they have bought 14% more gold than in the same period of the previous year. How do you envision these trends shaping the investment landscape for precious metals in the coming months? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.